let's start off. Immad, would you do us a favor and give a little bit of background on you, your founding story, maybe some of your angel investments that you've made?
Sure. I've been doing startups as an entrepreneur since 2006. So Mercury is my fourth company. I started, so in my previous company, it went on for most of that time period. I sold it in 2016. It was a YC company from 2009. It was funded by Union Square Ventures. And I wanted to angel invest for a really long time because, I was doing YC and startups and I'd see interesting things. And, one of the fun things of being in the ecosystem for a long time is you can see something right at inception and you meet the founders and you're like, oh, I really love this idea. And then you see it develop. Like, I was in the YC batch in 2007 with Dropbox, and I did 2 bets with people that this will be $1 billion company, and they bet against me. They still both, I guess, owe me a free dinner or something like that, I think was the bet. So I'd seen this stuff, and then in 2016, when I finally had some money, because you can't really invest without any money, and I'd sold my company, that's when I decided actually to see if I wanted to be a full-time investor. And, I tend to go all in on things. So I started investing very aggressively. I did like 30 investments in my first year. And I've pretty much kept a pace at doing that. So I guess I think I'm more than 240-ish investments, something like that now. I'm not tracking them that well just because it's still, I do it on the side, and Mercury is definitely my main thing. And, Mercury keeps me very busy. But I believe I'm in like 8 or so unicorns, or maybe 9 now. Airtable, Rappi, Embark just went public. I invested in seed round for that company. It's an autonomous truck company. It wasn't when I invested, but now it is, and it's a public company. I think a $5 billion market cap. So yeah, it's been fun. I mean, I love talking to entrepreneurs and trying to improve the art of investing. So I'm looking forward to this conversation.
Thank you. That's perfect. Elizabeth?
Yeah, hi everyone. I have a lot to learn from Immad, but I guess similar background, although I would say less successful. I previously had a startup as well, or actually I had a variety of failed startups, but most recently, several years ago, I had an advertising business, sold that company to a larger ad tech company on the East Coast. And I started angel investing after that. And so I think I have about 50 portfolio companies or so. So not 240. I do have a handful of unicorns, but I got into those later, so I don't know if that counts. But I think I, at this point, have made maybe more money from angel investing than from my exit. So, initially I started out sort of in the onesie twosies blackjack table here, and then have started, working my way up. So I think of more modern vintage angel investments that people might have heard of, Mercury being a great one. Thank you, Immad. But I think, some other wild cards out there, like I got in very early into a kid's book about, which is not even what I would call a tech business, but basically they're doing children's books and really trying to tackle hard issues. And they're doing phenomenally well, just because like nobody even does this. So that one I think will probably be a unicorn, and was one of the first checks into that.
I actually did not know that last piece. It's awesome. Well, let's talk about kind of the intersection piece, since we're talking about being a founder and investor already. Immad, how has being a founder influenced you in any way as an investor?
Good question. I think one of the things you have to kind of ask yourself if you're going to be an investor is like what value you're bringing to the entrepreneur. Unfortunately, money isn't like that good a value. It is useful, but there's a lot of people with money, and a lot of the time the good deals have enough money involved, right? Like there's lots of money chasing the good deals. So sometimes money can be a primary value, but it's not, I think, in most cases that you actually want to invest and your money is the reason that they take you. So I think that's like kind of step one. And being a founder just gives you a massive edge in that. There's the reality is like other founders are facing issues every day, whether it's like fundraising or hiring or sales or distribution, whatever. Like there's just so many issues, and it's just so nice to talk to another founder about them. I mean, sometimes they actually know the answer to things because they face them and solve them. Sometimes it's just like they just have good ideas and you can kind of talk to them. And because they know you're a founder, and I mean, I make it very clear to people, like I'm not doing it for money. I'm not, you know, my incentives are generally speaking much better aligned with the entrepreneur. Like they're not, with the VC, like they have their own incentives. Like maybe they want you to like burn through the money and like get to the next stage and all this kind of stuff. Whereas generally speaking, I'm like, hey, you know, whatever's good for you is good for me. Like I'll just try to be helpful. So I think in general, like there is a bias as a founder to one other founders as investors, and you know, you see that quite a lot nowadays. So that's probably like a major benefit. I guess like you know, over time as a founder, like I've gone through things and like I feel like there's a certain way to run a business. I mean, there's no one answer to these things, but you know, like I look for like those kind of attributes, like whether it's like grit and determination, or you know, people who are like really open to feedback and like want to learn and are a little humble. Yeah, those kinds of things are like things that I valued and have developed as an entrepreneur, and I look for that. So maybe there's like some kind of benefit of like being able to like see from my experiences like what is a valuable attribute, and like look for that in other people.
Yeah, no, that's awesome. I think just the empathy, you know, you've been there, you can empathize with another founder, so they just, I think, appreciate that. And then in terms of evaluating, it sounds like, you know, you're using your experience as a founder to assess another founder, and what's maybe gotten you to where you've taken Mercury is something that you want to see in somebody you're investing in. Elizabeth, what about you?
Yeah, I think empathy is one that I would really emphasize here, because, you know, when I was a founder, I would say that a lot of the investors I met really did not have any empathy. It is a hard journey, even when things are going well. And then certainly when things are not going well, to have investors like pile onto that is never a fun experience. So I think, you know, one of the things that I'm a big proponent of is I do respond to every update. And you know, I think in the cases where it's going well, it's more like, oh, thanks, Immad. You know, I don't really have anything to say. It's great. But I think in the cases where it's like they're going through some tough pivot or had to lay off a bunch of people or whatever it is, like that's, I think, the time to stand out and kind of build that connection, because it's such a lonely journey. So that's kind of the thing that I lean on. As far as diligence goes, I mean, I think because I have so little time, like running Hustle Fund is in many ways like a startup, I actually take much more of a large, diverse portfolio approach, where it's just like, all right, I know that things sound reasonable. I'm putting in smaller amounts of money. And this is why for a while I was largely sitting at the onesie twosies kind of table, because it's like I don't have time to dig into it. There's not a whole lot to dig into anyway, but I know the portfolio approach will just generally take care of things.
Yeah, and you're right. Hustle Fund is very much a startup. We grind, we hustle, and I think I think that shows through in how we help our founders too. So I love that. Let's talk about when we are evaluating startups. This is something I really like to get into with angel investors, and we can start with you again, Immad, which is, there's all these different inputs, right? Like when we think about things at Hustle Fund, we're thinking about the founder, the domain expertise of that team. We're thinking about the markets. We're thinking about the traction. We're thinking about the hustle, right? The execution and velocity. What are the things, Immad, that you focus on when you receive, you know, the deck or the pitch from a founder, that you maybe care more about than you think maybe the average other angel investor cares about?
think I stole this from Elad Gil, but I was definitely influenced by him. He's super focused on market. I would say I have a variant on that. I'm like both focused on market and also like what kind of thesis of like where do I see the world being in like 10 years time, and how does this fit in? So before I look at most other things, I like just look at the idea and say, hey, am I excited about seeing this thing come to fruition in 10 years time and being huge, right? That's like a significant part of like my initial view on things. I'm like, like with Mercury, for example, I'm like, hey, I hate banks. And like in 10 years time, like if all banking was this like amazing kind of product and business, sorry, I don't want to make this about Mercury, but like that's kind of like when you're investing in your own idea, it's like a similar kind of process. But that's kind of how I view things. Like I have a lot of opinions about where I want the world to be, like around like automation of things. Like I think it's crazy that truck drivers have to like sit there and drive for 13 hours. It's just bad use of humans, right? It's like no one's really loving that. Like I'd much rather like autonomous like vehicles did that. So I think there's like I have like various opinions about like where I think the world should go. I tend to hate a lot of like annoying things. Like I like doctors, but I don't like the healthcare system, and I don't like the banking system. So I have a lot of these opinions, and like that kind of helps inform like both having an opinion about like where this is going to go, and like whether this is a really really big market. Like I want to see like either already a $10 billion plus like market idea, or something that like in my view of the world can grow into like that big an idea. So I actually end up cutting a ton of things based on that. Sometimes it's like I just don't have an opinion about a thing either. Like like ed tech, I think is interesting. I've done a few investments in ed tech, but I generally just don't have like that strong opinion. Whereas like fintech, autonomous vehicles, there's all of these things I have like very strong opinions about. So I'll try to lean into that. Like I don't want to go waste an entrepreneur's time, but like I just never really liked the idea in the first place. Sometimes I do because of other factors, and I turn out to be wrong. Like actually the idea was much more interesting, especially when like an entrepreneur explains it to you. That's probably like something I bias on like more than most investors. And it makes my life a little easier, to be honest, because I don't have time to speak to everyone. But if I speak to someone, I'm already pretty excited about what they're doing. So then like that's like a tick box, and I could just focus on like other things.
And I guess one question there is, let's say a founder just blows you away with them, that you meet them, you're super impressed, but you don't love the business that they're chasing after right now.
I generally won't invest. I know that's like probably a little unusual. But my thing, I always tell entrepreneurs this, I'm like, hey, I really like you, but if I don't like 100% believe, then I can't support you properly. You know what I mean? Like, because they're gonna be like, hey, can you introduce me to investors? And I'll be like, well, I could, but I don't really like this idea. So like, I don't know if I want to go tell my friends to invest in it. So that's my thing. Like there's a few exceptions. Like if I really like the founder's just done like a previous unicorn and I really like the founder, like there has been like 1 or 2 times where I've made like an exception. But yeah, just me liking the founder to me is not sufficient. Like, I mean, I'll be like, hey, I'll invest in your next thing. I tell them about it. I'm just like, I'm not into this idea for this reason. And like, but I really like you. And so hopefully they will let me invest, but like, I want to be true to myself. So like, I personally like do want like most things to be attractive, tick box. Like there's so many investments out there, right? And there's so many ideas out there that like I don't want to like not be 100% in.
Well, I was kind of hoping you would say the opposite, because I think Elizabeth agrees with you. Elizabeth, I'll let you go.
I very much, I think investors tend to have this off Twitter battle about which is more important, team or idea. And I think within idea, one subset of this is market pull, which is what Elad Gil talks a lot about. I'm very much in that camp, that the idea matters a lot. I've just seen too many awesome founders flounder because they had an idea that was just so hard. I've even seen founders who found success in ideas that were hard, but the level of success was not as big as I felt was commensurate for who the founder was and everything they did. You would much rather be pushing a boulder down the mountain than up the mountain, in my opinion. So I filter very much based on ideas. And I think because my day job is pretty similar to angel investing, there are some differences because I don't want conflict between my angel investing and Hustle Fund. So all of my angel investing is outside of what Hustle Fund would do. But I do look at things in a very similar way because I'm the same person. And one of those things is there enough greenfield to run? So not only do I think this is a problem that will have fairly easy customer acquisition, but am I seeing 20,000 of the same idea right now? And if the answer is yes, I probably won't invest because, I think it actually drives up customer acquisition costs and it makes it actually harder. And so anyway, long and the short of it is like Immad, I will pass based on idea, even if the founders are amazing.
Well, that's perfect. I think let's talk then about the market today. So the market today is frothy. It's the wild, wild west out there at this point. It seems like metrics are kind of thrown out the window. You've got the Web3 hype. There's a lot going on. What's your strategy, Immad, right now? Are you pulling back at all in your angel investing? What's your analysis of what's going on in the market?
It's definitely a great time to be an entrepreneur. So no doubt about that. I'm not pulling back. I'm investing about the same amount. I would say, there's a lot more, and maybe it's been happening for a while, but there's just this continuous kind of drive of more and more startups, right? And startups are like a lot more ambitious than they used to be. Like 4 years ago, people weren't, well, maybe 4, but 5 years ago, people weren't doing like every idea I see is like going after huge markets and doing big things. So I think there's a lot of like excitement and reason to continue investing. And I think it's fairly reasonable to consider most things at like 2x the valuation that you might have put them at 2 years ago, maybe 3x, just because the overall multiples in public markets are up, and also where it was very like it was seen as an exception to hit a unicorn, right? But now there's like obviously 4 freaking or $3 trillion companies, right? Like the top line of what is possible in like the startup ecosystem is just like way higher. And that's not just a trillion companies, there's way more $10 billion companies, there's way more $100 billion companies. So there's a reasonable like thing to say that evaluations should be higher, and maybe they should be 2 or 3x higher. Where obviously it breaks is like when they're 10x higher for like less done than, I just can't bring myself. I think maybe I've done one company that's like, even that was like pre-launch. I can't think of ever doing a company at like above like 20 pre-launch. I think is probably the thing I've done. So I think you do have to have discipline, and like, as long as you don't get carried away with things. There's still actually like at early stage, I think there's still tons of opportunities. I actually feel worse for like Series A and growth investors. I think their valuations are getting particularly carried away, and their multiples are not that much higher. If you're mostly investing at like below 50 million valuation, like whether you get in at 10 or 20, yes, it makes a difference. Hopefully there's like more progress there, but it doesn't like fundamentally change the game you're in. Versus like, these growth investors that used to do like $200 million valuations are now at like $1 billion. So I think that's crazy.
Totally. Elizabeth?
Because my angel investing does not conflict with Hustle Fund, it's kind of funny because I feel like I play in these weird spaces. So Hustle Fund does pre-seed software. So I don't do that with my angel investing, right? Because otherwise I'll just write that check out of Hustle Fund. So when I'm investing in software, it's by definition later. And I have been doing actually the really late stage. So that is where valuation becomes an issue. Or I'm investing very early in non-software things. Like I've done a lot in food. I mentioned a kid's book, which is also not a technology company. And those valuations are very reasonable. Like the frothiness has not really carried over into all sectors. So I think there are a lot of good opportunities in some of those, especially around recent trends like, no to low alcoholic drinks. That's kind of an interesting area. For a while, all kinds of waters and seltzer waters was a big hit. Kids book about, of course, is like very unusual idea. So think just random stuff, I would say. At the late stages, that is something that I have top of mind, but I think my thesis around late stage investing is if the company seemingly has product market fit, where it's like, wow, yeah, they are really getting lots of customers repeatedly, and customers seem to really like them and stay retained, then I don't want to say I don't care what the valuation is, but I care a lot less, because I very much believe in the barbell strategy. You either want to go in really early and kind of maximize your multiples, you're taking the most risk, but that's when you can get the greatest gain. Or you want to go in like when it's proven that this is a great business already, and I see that as better than what I can get in the public market. So, but I think it's this middle zone that I don't really enjoy playing in, where you see these sort of frothy Series A deals every now and then at call it 100 million post, and it's like the company clearly does not have product market fit. They don't really have much revenue, and that is something I would stay very clearly away from.
Yep. Well, on the same topic, just kind of flipping to the other side of the coin, there are a lot of founders on this call. There's almost 200 people on this call. What do you think about if you were a early stage founder today, Immad, and now you're running a unicorn business? It's definitely found product market fit, Series B, all that. But if you were earlier stage, knowing what you know about the pre-seed market today, do you have any advice that you would share to the founders on the call?
There's so much advice that it's hard to pick the right one. It depends how pre-seed you are. I think like if you're at the idea stage, I would definitely like try to be ambitious. Like I think this market is like awarding ambition. Like you have to have big ideas and go after them. I wouldn't get like too swept away necessarily in like what valuations other people are getting and like how all that kind of stuff. I think you're gonna have to focus on like really building something valuable, and like other things will follow from that. And at pre-seed, like that means like building a great kind of founding team, like validating the market as much as possible, and like getting some early customers. Even if you don't have a product, you can do a lot of that. Starting to build that product, having a prototype, ideally getting some revenue and traction and all of that kind of stuff. So this is the basics really, but like I think like it starts with the basics, especially if you're just gonna ask for general advice. And like I think if you do the basics right, no matter what the like current frothy or not frothy market conditions are, like everything else will follow from that.
Elizabeth, any additional thoughts there?
Yeah, I mean, I think that it is a frothy market on the net, but I think it's fairly bifurcated. It's always one of those situations where for most people, when you raise money, you're not hot until you're hot. And so I think if people go into this thinking, oh my gosh, like the roads are lined with gold, I don't think that's necessarily the case. I think if you're somebody like Immad and you've had a successful startup before, then maybe it's a lot easier. But if this is your first time starting a business and you're kind of new to this and figuring this out, it may not be the case where you can just raise off of an idea. And so I think all sort of rules still apply, which is do the most de-risking that you can. And it's a numbers game in meeting with investors, and then maybe you'll hit it, and then investors will kind of create this frenzy, but maybe you won't. I do think a big difference though is that when I was raising for my startup in 2008, 2009, a successful raise might be, oh, somebody gave you 25K. In this market, a failed raise might be, oh, somebody gave you 50K, right? So I think comparing markets, it's still better. Even if you are not very successful raising money in this market, you're still way more successful than how things were back then.
Yeah. One founder recently that I was helping think through their fundraising strategy, and he's a friend that I've known for a few years now, and he actually worked at Uber. He was like a senior PM at Uber. He's never founded a company, but he has a great co-founder. They're gonna do something. They're deciding if they want to just like put an MVP out in the market or go raise what they said off of an idea, $2 to $3 million. And I said, I think that's going to be pretty hard. Like, yes, the market is very frothy, but it's frothy when there's like the FOMO piece happening. And if you aren't able to get that kind of cyclone spinning, you're not going to raise $2 to $3 million on an idea. And it comes from, it is frothy, but like you said, it's not just like there's money lining the streets that anyone can just pick up off of an idea. And so there's a balance that you kind of have to play there. But certainly you can command a high valuation should there be a lot of interest in funding your company as a founder. On a related note, when, Immad, should a startup look for angel funding over, let's say, like a seed stage VC firm?
I would say just like do it all in parallel. I think at seed stage, there isn't like as much of a need to go find a lead, but I do think there is value in like lead investors that like really believe in you and can back you, kind of thing. But yeah, I don't think you have the luxury, generally speaking, to like pick one or the other. Like the universe of investors is not so huge, and maybe the universe of investors that you can access is small, because smaller than all of it, just because, you know, a lot of them do need referrals still, and that always helps. So I would say, you know, go after both and do it in parallel. One thing I try to do when I've done raises, I do like lead investors. So I try to actually like kind of phase it a little bit. Like I'll talk to a bunch of angels, get some momentum, get some early checks, then talk to a bunch of like leads, try to, you know, use that early momentum to try to hook a lead. And then in parallel, like when I'm saying like this kind of sequence, I'm talking about like days. Like I'll spend a few days on angels, spend like a week on lead investors, and then like kick off like the rest of the angels. And that gives you like momentum to like maybe close a lead pretty quickly. And like with seed stage leads, like it shouldn't be taking you weeks and weeks to close them. Like they should be able to make a decision within a week, I would say, in general, maybe 2 weeks. So, you know, if they don't come through, you don't lose momentum in your round. Like you can still just close off the round with the other angels that you're entertaining. Yeah, but if you do get a lead, then obviously it makes your life much easier, because they'll do half the round, and like the FOMO from like a lead being in will try to help you get like a lot of investors in. But obviously this relies on like you having somewhat of a network and a way of getting access to that kind of people to sequence it like that, and not everyone has that luxury.
Well, actually, so that's actually my next question. I want to kind of throw you a softball here, Immad, and talk about the angel directory or investor directory that you have put together at Mercury. That is the best executed intro database I've seen.
Thanks for saying that. Yeah, we have mercury.com/investor-db. But basically, I've always found, especially with seed investors, I would say this is mostly true for VCs as well, is like, you know, there isn't a good place to really find out who they are, what they invest in, how to reach them, like all of those stuff. Like, it's all disparate. Like it kind of used to be that AngelList used to do this, but they kind of stopped working on that. Not to speak badly of them, I still think they do a lot of other things, but that's just not their focus. So, you know, I wanted to collect together, like, these are actual angel investors that are actually investing currently, and like get like first party data on all of them in like a very succinct format. So that's what the Investor DB is. And it's kind of part of this overall other program we have called Mercury Raise, which connects seed stage investors with seed stage companies. We run that every 2 months or so. And because of that, we have this huge internal database of these investors, and we're like, hey, let's expose that. And like, it's kind of become like a kind of a cycle. So yeah, it kind of comes back to the earlier thing. Like, it is hard to get access to investors. Even a lot of people on the Investor DB, yes, there is ways of like getting, talking to them and DMing them and all that kind of stuff. And we've tried to surface those, but all of those people will still take a warm intro and give it more credibility than like a cold outreach. So I think along with that, you really do have to like work your network and try to establish your network in order to really be successful in a fundraise.
Elizabeth, did you have to take that call behind you?
No, I don't think so. Is everything okay?
Awesome. Anything to add on that, Elizabeth?
I think just to an earlier point, it's funny when people talk about investor leads. I think you have in this mind, oh, they're going to be the first ones to jump at this opportunity. But in my experience, it's almost the opposite. And so I think just building on Immad's point, like actually by doing all these meetings with angels in parallel, then you can build momentum to almost put some pressure on the leads. I think that a lot of people get worried that, oh, once you go down this path of trying to talk with angels and you start, signing people on a safe or whatever, then it's hard to kind of switch into a price round. But that's actually a very solvable problem and a lot easier to solve than trying to get a round together to begin with. So that's what I would encourage people to do as well.
Great point. That's a great point. I guess one of these questions that I think probably resonates with I guess most people on this call who are on the founder side of things. Advise Immad on balancing angel investing with running a company, because I know there's this hybrid approach that's become very prominent in the tech ecosystem. Like you said earlier, as a founder, a lot of people want other founders to invest in their company. So how do you balance that? Obviously, running a company is more than a full-time job in and of itself.
Yeah, number one, don't have any other hobbies. So I think like if you're gonna try to do too many things, like it's not gonna work. Like I don't really have other hobbies apart from angel investing. Yeah, I guess like that just speaks to us, like, you really do have to invest time in both if you want to do them successfully. So you have to like carve back time out of other things. I think it depends how you're doing it. Like angel investing with small checks is not that time consuming. If you have to work really hard to like find companies and talk to a ton of companies, blah, 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 then it's much harder. If you do have like some level of deal flow where they're coming to you to some extent, and maybe at times you push, but mostly it's pull, then it's a lot easier. Like, even though I've invested in so many companies, I don't talk, maybe I talk to like 1 or 2 companies a week. That's like 1 hour of my time in a week. So it's not, so bad.
Super helpful. I went over to the poll section and you could see the results that about 50% of the people on the call are a founder, 28% are angel, 20% are both. So that applies, what you were just saying applies to about 20% of the people on the call, which I would bet that, 3 years ago, even if you ran that same poll and we had this exact same event, there would be less than 5% that are doing both. I feel like that is a very new age thing. And I think it's awesome for the ecosystem, just to have more founders investing. So that's great. There's a number of questions in the Q&A. One question that Christopher asked is about kind of access to founders. So many people are investing through syndicates. AngelList, like you mentioned, is super popular for that. But a lot of funds and syndicates are kind of protective they're like a firewall between the founder and the LPs who are investing. What if you want to be a helpful angel investor? Like, what do you recommend somebody in that position do to add value?
I mean, I think being an LP is just a different game to being a direct angel investor. In general, like, you're not bringing I know AngelList tries to portray this in a different way, and maybe some other like syndicate leads and funds are different to the way I do it, but mostly when I'm running a syndicate, which I've done in the past, and I've still run a rolling fund, I'm already doing a lot of work with that founder and I'm making that decision. I don't have time really to like vet the LPs to see like, oh, can they add value to this particular person? Like, yeah, that kind of work would obviously make it so I can't also run Mercury. So I would say in general, like it's just you're playing a different game. Like your game is to like pick the syndicate to back or pick the fund lead to back, and you're not really playing a game where like you're necessarily providing value to the companies. I think if you are interested in that, then you should do direct investments and like and then in terms of like getting in touch with people, like that's kind of what they want. So
they want that, right? That's what ultimately why when capital is a commodity, the founder wants that help. I'm going to plug Angel Squad here specifically. So for folks who are new to the Hustle Fund ecosystem, we have this program called the Angel Squad, and one of the main points of it is to invest together in Hustle Fund's portfolio companies that are going on to raise more money, and then help those companies. So we intentionally, even though it is a syndicate, we intentionally pull this group of people together who invest in that company together to help support the company that we invest in. So for example, we hosted a design office hours for a couple of our portfolio companies with the designers who are in Angel Squad. And before that event, the founder didn't necessarily even know those designers, but they were able to leverage the skill set of those designers. So that's just kind of another wrinkle that's going on in the ecosystem that we're doing, that we think is pretty important if you want to stand out from the rest of the capital that's out there. Another popular question. Oh, go ahead, Elizabeth.
One other thing that I would add, and I would actually encourage all the founders on this call who are raising from syndicates, is I would ask the syndicate lead if they would be willing to send out, emails to their LP base to help with sort of micro actions. Because I think even in syndicates where people are not, they're doing the syndicates because they don't have a whole lot of time. I think there are a number of things that are really easy that can go a long way. So I think one thing that the Hustle Fund syndicates does well, if I'm going to toot our own horn, is all the Angel Squad members like tweet. They tweet job posts, they tweet announcements, like product hunt voting, things like that. Like that can actually go a really long way. That's leveraging smaller dollars in a syndicate. And now if you have 50 people doing that, that can be pretty incredible.
Twitter, a question that came through is about Twitter, and you're both very active on Twitter. You both have big followings. We should drop their links because both of them are must follows. If you're going to bother opening the Twitter app, which I recommend, you should also follow these two. How do you think about like leveraging Twitter to benefit you as a founder, maybe benefit, you already mentioned benefiting portfolio companies. Maybe Elizabeth, I'll just go back to you on this one. I know you're a big fan. Let's just talk about Twitter for a second.
Oh, I love Twitter. Actually a couple of years ago, I wasn't into it at all. And then we noticed that actually over half of our deal flow at Hustle Fund came from Twitter. Like we ran our own marketing analytics and that was what we found. So then we did Twitter on steroids. Like that's why we're always on Twitter. It may feel like, gosh, why is everyone on the Hustle Fund team wasting so much time on Twitter? But that is the reason. But I think even beyond that, just being on Twitter, I've learned a lot of other things. So number one, kind of the mechanics that I just talked about, that's how a syndicate can really help a founder. Number two, certainly from an investor perspective, I just kind of mentioned that you can increase your deal flow by being active on Twitter. I've seen a number of friends who previously didn't even really have a Twitter account, or they were very inactive, and they've now built up their deal flow. I think even somebody like Turner Novak, who kind of came out of nowhere, he is like, he has surpassed everybody on Twitter. So things like that. And then on the founder side, actually, it's a lot easier to get to know people now if you don't have relationships, if you don't have a network on Twitter. And that actually is a good way to start pitching investors, just like being a bit more active and vocal on Twitter. Some of my portfolio companies actually are very open, like they're building an open, and that actually enables everybody to kind of see, how do you think about things? So it works both ways on the founder side and on the investor side. Like, how do you think about either investing and working with your portfolio companies, or how do you think about running your business, and what are you working on and focused on? I think Twitter is a great marketing tool for everybody.
Yeah, I mean, part of the reason I'm active on Twitter is, I guess 4 years ago when we started Mercury, I was like, wow, I should really be more active on Twitter, and like, that will be a useful source of like customers for us, which has been the case. But I also think the other piece, which kind of speaks towards the building in public thing, is like, I think a lot of Mercury is about like the brand, and putting a face to Mercury is important. Like, I don't want it to be just a faceless kind of, business bank account, and like it sounds boring, right? Whereas like, I think, I want Mercury to be like aligned with entrepreneurs, and like helping these people succeed. So like, most of the content I do on Twitter, I mean, I just do some personal crap as well, but most of what I do is like trying to put educational content out there and trying to help other entrepreneurs. So yeah, I think people appreciate that. Hopefully it's helped some people, but it's just also like very much is in line with like what Mercury is about.
Little Twitter tangent is always good for a conversation like this. Especially, I mean, again, thank you for dropping the links in the chat. I've found a ton of value in both of your just tweet storms along the way. I guess we have about 15 minutes left. I want to go back a little bit to the investing side of things. One thing that is kind of always a hotly contested strategy amongst angel investors and funds is your approach to taking pro rata or follow-ons. Immad, what is your approach as an angel?
I think in general, don't bother with pro ratas and follow-ons as an angel. I think the strategy is completely different if you're like A16Z and you've got like an infinite pool of money to delve into. I think most of the time, I've done like some of the maths on this. Like, I've done a few pro ratas as well. Like, it doesn't, like, your first check is like most of the economics in the investment, has been my opinion. Even if by the second check you have more conviction, yeah, I don't think it's worth it, generally speaking. And it's, at least from my perspective, I want to not do tons of work. So like, I don't want to be evaluating pro ratas for every single company every single time. So it's much easier for me to just say, hey, I'll do the first check. Yeah, there are rare occasions where an entrepreneur really wants me to invest more, and maybe I'll do it just to help, kind of thing. But in general, like, if a Series A is happening, the entrepreneur almost never wants the angel to do a pro rata anyway, because they're trying to like give allocation to their other leads investors and the Series A VC and all of this stuff. So yeah, I'd rather just be helpful to the entrepreneur and say, hey, I'll pass on it.
What about you, Elizabeth?
Yeah, same. I mean, I think nobody has an infinite amount of money. So essentially what you're deciding is, here's my whatever pool of money. I can either write a bunch of first checks, or I can take all of it and plunk it in this one company where I do have more information now. Which door would you rather have? Door number one or door number two? And I think that in general, door number one is better. You would much rather have more shots on goal with the same amount of money at a lower valuation, potentially higher multiples. I would say the exception is if like it turns out that company has really strong product market pull, is growing 50 to 60% month over month, like repeatedly, and all this other great stuff, then maybe door number two could be better. But to Immad's point, then you have to take the time to figure out, like, is that what you have behind door number two? And that's an opportunity cost in its own sense as well. So for me, most of the time I have not reinvested, at least as a personal angel.
I guess this kind of leads into a portfolio construction conversation a little bit, which is, Immad, when you're looking at these early stage investments, is your check size pretty consistent, or are you varying it based on your level of conviction?
I used to do this whole like thing where I was like, okay, I really believe in this, double the check. I'm not sure about this, half the check. And then God, like, I've had so many misses doing that, like, not misses, but like, I was like, take like Substack. I don't think they'd mind me saying this, but like, I was mostly investing 100K at the time, but in that one I was like, oh, who knows about newsletters, because this was like very, very early at Substack. So only for 50K, and that, like, it's like most of the value of like that 6 months of investing is like Substack probably in the future. So yeah, I've had a few of these and I'm like, okay, you really don't know at seed stage, right? Like if you get enough conviction to invest, I think nowadays equal check on everything is what I do. And sometimes I can only get a small allocation, but most of the time it's like the same amount everywhere.
Is that same for you, Elizabeth?
Yeah, I mean, I think the only like exception is like, you know, kind of when we were getting Hustle Fund started, I felt like, oh, well, I have to conserve more cash because I'm going to need this to get this off the ground and all this other stuff. So, you know, I think it was more about life circumstances than anything. But I agree very much with this. You just don't really know what is going to take off. So
that was something I learned a few years ago from First Round Capital. They shared that they had been kind of keeping tabs on their conviction level. And in the early days of First Round, they were actually investing more based off of their level of conviction. And they did an analysis years later, and they determined that there was no correlation at all between conviction and outcome. And this is like one of the top seed venture funds in the world, right? So that was one thing that they preached. They're like, do not vary your check size. It's just, you just got to keep it consistent because you just don't know when you're going this early. So sounds like we all agree there, but it's actually really hard to put that into practice. Sometimes you're like, this is the one, I want to go big on this one. And you just kind of reel it back in.
I mean, I'm doing this equal check thing, but I do feel like sometimes you really, really have a feeling. And often I think I'm like, when I really, really have a feeling, it's rare that I'm wrong. I think 3 out of 4 times I'm like right about that feeling. And like,
so
it's
okay,
rare
so
though.
that's good to know.
1 in 50 companies that really, really have a feeling.
And so then you let yourself go wild with that.
Yeah, I would say like they're almost all unicorns. That I really had a feeling in, but it's rare.
Man, okay,
I think I'm that level of picker. So I mean, I'm very much about the portfolio strategy. I think if you get the portfolio strategy right, then you're not picking, you're just running your strategy. Because I would not consider myself to be a good picker.
I would consider Elizabeth to be a really good picker, just for the record.
Yeah,
but that's very, you're hard on yourself, Elizabeth. But yeah, that's that battle, Immad, that you just shared is the battle. It sounds like Artie just went through that pain, and it's tricky because, I mean, it sounds like you've been right about it, and so it's good that you let yourself, you know, go. Maybe there's a case to be made that like you get 1 out of 10 or something where you get to go a little bigger. You don't just like have it vary every time. I don't know. What do you think?
Yeah. It's easier to just say. Actually, it's easier for the entrepreneur as well, because otherwise they're like, "Oh, can you do less?" Can you know? I'm just like, I do this. I do 100K everywhere. Like, you want me to do less than yours? You know, that's not. It's just simpler. Like 100K everywhere.
It's simpler to just say this. My number is what. Yeah, that's fair. Well, good. Now I'm reeling myself back in. That's okay. Let's see. We got time for maybe a couple more questions here. Just kind of a general advice on very new angel investors. Again, this is why we started Angel Squad, but for people who are going to write their first check, like, do you have some go-to wisdom that you usually share?
I would say, like, don't just write the first check. I think come at it with like a philosophy where you like decided to write at least 10 checks and you put aside money for that. I think 1 check is not going to do it. Like, you need some portfolio. Otherwise, I have a few friends that have done a couple of checks and they're like, "Oh, angel investing's not for me." I'm like, you didn't even do the game. So like, I don't know how you're deciding that. Like, I would say actually 30 checks is probably the minimum. So be prepared to like budget for that. So that's one thing. I think before even getting into this, like you kind of have to do it for the right reasons. And actually, like, what was it, Christopher said something that I thought was, he's like, "Oh, I don't have access to these companies." So like, I think that's like actually the wrong kind of thinking. Like, you have to go, okay, like, what is my special power and how am I going to deliver on that? Like, you know, by the time I was angel investing, I'd already been a startup founder for 10 years. I had a really big network of entrepreneurs. I I hustled for the name of a hustle fund speaks for it, but yeah, it's boring. But I went to like, when I first started being an entrepreneur, I was going to like 4 events a week, right? Because I was like, I don't know one, I know nothing about this. Now I don't go to events because they're like, not that valuable once you like networked enough and you know things. But like I was working really hard. And you need to put in that time before like you're going to be getting the best deals or things like that. So I think, yeah, whether it's like you're going to find them on Twitter because you do a Twitter following, or whether you're going to like go to all the demo days and find them there, or you're just going to, you just have to have like something that makes it so you're going to have access to like these companies, and it can't just be like, I have money. So I think it's a combination of like, A, you do need the money, B, you need like a strategy, like what's your differentiator? Like my original one was, I'd done 2 YC companies. I was like most of the things I did in the first like year were like Y Combinator companies. So I was like, I know this system. I know most of the time if I email a YC founder and I'm like, I'm a YC alumni, like, will you take my money? They'll say, like, at least they'll talk to me. So like you do need to have a strategy. You can't just approach this with like, I have money. But there's lots of strategies out there at the end of the day. Like there's lots of entrepreneurs, lots of them want money. If you can provide some value, that will let you invest. So it's like, what's your value? What's your network? How do you work it? But this isn't like something you can like passively do. You have to like work it.
100% agree. I mean, I think for me, I would actually even size the portfolio even more, especially in the beginning when you really don't know what you're doing. You are going to probably lose on a lot of deals and just kind of go in with that mindset. I would say probably the first 30 to 40 companies that I invested in just kind of more or less all went to zero. And so as such, I would probably suggest 50. And I know people are like, oh gosh, how do I have money for 50? Or at least some people might wonder that. And so I think the way I think about it is, all right, can you do $1,000 into each company? And so that's $50,000. You don't have to do it all now. Like you're not going to get 50 great companies this year. So can you do it over the next, even call it 10 years? So like 5,000 a year. If you have that kind of budget, then I think you can get into the game. But then to Immad's point, you have to have a strategy. And often people ask me, well, who is taking checks at 1,000? And that does make it a little bit harder. You're either doing syndicates, in which case you're like buddying up with syndicate leads who have good access in deal flows. So that's one strategy. Another is that works really well is mentoring at top accelerators. So probably can't mentor at YC, but like Techstars, like I'm sure they would love to have you as a mentor, or Acceleprise or Alchemist or any of those. And actually you can see the companies before you decide, throughout the program, like whether you want to invest or not, right? And so, but that takes work, like to do your office hours or whatever it is. And so then the question is, well, what sort of advice or help are you giving in that circumstance? So different strategies. You've certainly seen the meme strategy work. A number of people on Twitter like amass these large followings, and then everybody goes to them because they want to be tweeted about. So that's another strategy that I would say Turner, Packy are all doing really well. So lots of strategies could work, but all of them are a lot of work. So I think a lot of people go in, like Immad said, oh, I'm going to invest in this company or that company. But I think you have to go in with like a plan, and it's a long-term plan and a pretty committed plan.
I'd also add a few things. Like number one, you can kind of like shadow invest as well to like see how you might have thought about something and whether you were correct about it like a few years later. So even when you're not ready because you don't have the money or whatever, like you don't need to like not be doing something. Like you can still be learning about it, but look at every company in Y Combinator demo day or whatever, and like say, okay, these are the most interesting for these reasons. And like a few years later, like I was doing that for like basically like 5-7 years or something before I started investing. So like that gets you learning, because you're like, okay, I was so sure about this company, but I was completely wrong. It was a stupid idea. So that's one thing that you can start doing. I would also say, to Elizabeth's point, like the hardest like investments are like at the start, right? The first 10 or 20, they're hard because you're not good at it, and you're like the way you portray your value to the companies is not that good either. Like no one wants to be your first investment. Like whereas when you come at it like it's your 21st company, you're like, I like your company because I invested in these other 3 healthcare companies and they did it this way, but I know your space, and like if you did it this way, I could be helpful there. There's just like this kind of self-fulfilling aspect to investing. but it takes a while for that to kick off, right? And then also after you've done 20 or 30, the next 5 you do might be like investments where like this is a friend of one of the founders you invested in, and he's like, he or she is like, you should invest in this company because it's interesting and similar to me in this way, kind of thing. So you can end up getting a lot of like these kind of compounding benefits from investing, but you really have to be willing to like, and it's in most things in life, the first bit is the hardest, but you have to work really like extremely hard for that first bit to be successful for the later part.
I feel like that was a perfect way to wrap this thing up. Immad, what you just did was kind of summarize the benefit of the compounding learnings from being an investor, which I think were also compounded by your learnings from being a founder. And that intersection creates this momentum for you from like a learning perspective, from an access perspective, from a decision-making perspective. So I kind of think that was kind of the goal of what we were trying to do tonight. So thank you for articulating that super well. Thank you for coming on and sharing your wisdom and your time with us tonight. Really appreciate it. This is recorded, and we can share this to people who join late. If you missed some of the beginning, happy to fill you in there. So thanks for coming, and Elizabeth, as always, thanks for coming on. Elizabeth is a regular on our Angel Squad calls. So we're very lucky to get to have her in this unique conversation tonight.
Yeah, great conversation. Thanks for doing a great job moderating, Brian. Good seeing you as always, Elizabeth.
Yeah, it's good to see you.